Welcome to M2M. Here we are again with another interesting topic today to discuss about the prevailing interest rates and whether it makes sense to invest given the low interest rates. And we have so many other attractive investments. The equity markets are perking up again. Gold has glittered quite a bit. So once again, I'm joined by Manoj Trivedi, and we'll cover about whether fixed income investments really make sense in today's time as of June 2025. So, Manoj, what do you make out of the prevailing interest rates and whether there are attractive enough options for the retail as well as HNI investors?
Hi Ram, glad to join these conversations with you. Uh, so, lot of options always for all types of investors, but speaking specifically of interest rates, we had a long history of interest rates of early 90s when interest rates were very high. They were regulated, and RBI used to put a cap on what's the maximum interest rate. And even then, NBFCs used to figure out ways such that you could pay interest rates at, believe it or not, 22% per annum. That is how high the interest rates used to be in those times. Compared to that, now we have really low interest rates. Uh, but we also need to understand why the interest rates have fallen.
That is very true, Manoj. Interest rates are low not only in India but across the world. Japan has had very low interest rates. So why are we in such a low interest rate regime as of today?
So, interest rates are a factor of three things. One, what we call as real interest rate, that is the real cost of money, opportunity cost of money. Okay, what can you do with that money if you are not investing? I can go and spend, buy a TV or whatever. The second factor is inflation, and the third is the risk associated with uh, giving a loan, parting with money. Given that we are talking of repo rates, which are indicative of interest rate changes, there is no risk premium there because it is government, banks lending to banks. So the differentiating factor is inflation. So back then, the time when we were talking about, inflation used to be in double digits. Today, inflation is at historical lows, and that's the reason why we see interest rates significantly lower. And this is likely to continue into the future. So it's not just we have reached a regime of low interest rates, but this is likely to continue.
So our equities a better bet. Nifty 50 over the last 1 year, if I look May to May returns, it's given around 8-9%. Even a year where the markets have been very choppy, there have been a lot of events. We had the war and all of that going on. In spite of that, Nifty has done reasonably well, and as you know, over the long term, Nifty has given about 12 to 13%. So, given that, why even consider fixed investments, fixed income?
So, which is your favorite curry, Ram? Knowing you, I think it is paneer. And what if I serve you paneer for lunch and dinner for the next 10 days, 15 days, 30 days? Would you appreciate that? Okay, so just like in food, we have a balanced diet. Similarly, we have asset allocation in equity, in investments. So equities serve a very useful purpose, and so does a fixed income security. Equities are meant for generating a higher rate of return, whereas fixed income securities are supposed to provide us with stability, okay, and liquidity, which an equity instrument can provide, but with a lot of risk. Gold is another instrument which can probably give you stability, which can give you some decent returns, but in recent times has outperformed almost all asset classes. But that is because of the geopolitical situation. It may not again give the same returns going forward. So, equities are a great investment, and so is gold. And despite the low rates of interest, fixed income securities also make a lot of sense.
Absolutely. I mean, we all like spicy food, and variety is very critical. So, does it mean that given that interest rates have kind of bottomed out and bond NAVs would have commensurately gone up, it's time to just exit all your bonds and then move into equities? How do we construct? I know seems to be a mundane or a elementary topic, but often the importance of asset allocation is lost out on many of the viewers. So it helps to kind of carve out what it means for a conservative, moderate, and an aggressive investor, given all of these. So that an aggressive investor who wants to build a large portfolio over the time for the retirement, etc., they allocate accordingly and benefit from the wealth creation. At the same time, a conservative investor, a retired person, doesn't fear losing money.
Right. Obviously, every investor will have his or her own objectives, and accordingly, the asset allocation will have to be devised. Uh, but the point is, a fixed income security gives you liquidity and safety. It adds stability to your portfolio. So I would not advise someone to sell all the bonds because or the bond funds because the NAVs have gone up. And you know, selling that and putting it in equities might be taking an overexposure or over allocation to equity. Just like equities, interest rates will fluctuate. Okay, so that might warrant a bit of a tinkering of the asset allocation, but moving totally out of a asset class is not advisable.
Got it. So Manoj, this tinkering that you mentioned, right? There is a talk of tactical rebalancing and strategic rebalancing. So, I mean, the way I see it, right? I mean, for example, I manage my portfolio, right? I have enough money for liquidity. We follow this LSG framework that we always talk with our clients. So, enough money for liquidity, enough money for safety, so that I am covered for the near term financial goals, which could be 3 years, 4 years, 5 years. So I'm at peace. I don't have to worry about any impending disaster, etc., etc. I have my health insurance, life insurance in place, and so I can sleep peacefully for at least 5 years, right? And whatever I don't need beyond 5 years, it goes into growth assets. It could be majority equity, and there could be layers within equity, and so my point is, where is the role for fixed income in having a kitty that I can use when markets crash? So how do I distribute fixed income between my liquidity, safety, and dry powder, as I call it? That
Right.
will be a slightly interesting topic, because whatever we discussed so far, see, the thing about personal finance is that most of it is, we end up repeating the same thing again and again. But now let's see from this perspective as to that LSG, liquidity, safety, growth, and then the dry powder angle, right?
Okay,
Yeah.
firstly, congratulations, Ram. You are in a great space where you can afford to sleep peacefully for next 5 years. Not many people can actually be in that position. And precisely that is driving you to ask, how do I keep my powder dry? Okay, so if your liquidity and safety requirements are taken care of, then it makes sense to invest a lot more in equity. Having said that, equity markets are volatile. So if you are a smart investor, you will be aware of how the markets are moving, and you will be aware of the factors that drive equity markets. For example, we knew, okay, what would be the implications of war, what will happen if oil prices go up. We had a discussion on that as well. So a smart equity investor will need to anticipate which way the market is likely to go, and accordingly, as you said, keep the powder dry. So if you are anticipating a crash in markets for whatever reasons, particularly when there is lot of panic or uncertainty in the markets, equity markets tend to go down. And that is the time where you have to use your dry powder. Okay, because markets will eventually move up, the uncertainty will clear, wars will end, but business has to go on. Okay, you and I will have to continue to work to earn our bread, and that is true for almost everyone. So the economy will continue to grow, and that will get reflected in better returns from the equity market.
Absolutely, Manoj. I think the problem is people tend to panic when markets correct by 10%. I would say that's a great time to actually uh, deploy your dry powder.
Right.
I mean, everybody needs to have a certain mindset and a written rule, right? If market falls, let's say 5%, I'll start adding some, little bit of money, and and to that extent, if the safety goal is reasonably well populated, let's put some numbers to this. So let's say I need 10% in liquidity, 20% in safety, and 70% can be in growth. Now, within that 70%, I may decide to put 10 or 15% as a strategic buffer, and markets, let's say, correct. Now, historically, every 3 years, markets have always made a new high. Historically, you look at 20, 30, 40 years of data. I'm not talking about a Great Depression kind of a situation, which at least India hasn't seen. And India, thankfully, we are in a growth phase. We are yet to develop. So the macros are pretty much clear there. Our per capita is only 2,500. The way I would see it is to then use up the strategic buffer that you have if the market's correct, and if market's correct further, then one has to take a call, right? If one is panicking, then stay put, or that, right, let's say markets have corrected 20-25%. I'm talking about the index, not about specific stocks, because always in a bear market specific stocks may correct by 40-50%. So that's where one has to again have a balance, in my view, between too much exposure to a stock to versus a portfolio. And I would say that if there is such a big correction and I am having, let's say, 5 years worth of safety goals already taken care of, I may reduce it to 4 years worth. And also things change, right? Like you may have stashed away money for your kids' education, and typically being conservative, you would have stashed away more money. And now you have clarity that that goal is approached, or that goal is kind of halfway met or even fully met. Then you can actually release more and put it into growth.
Absolutely. And unless there is a change in lifestyle, or you know in situations, for example, family getting increased or decreased, that kind of a situation, if you leave those apart, your asset allocation is fixed, as you said, 10, 20, 70, that kind of a thing. Then in markets which are volatile, just stick to that asset allocation. Markets tank, that 70% becomes 60%, so automatically add 10% from your fixed income and make it 70%. This will automatically result in a much higher growth of your portfolio.
Perfect, Manoj. I think we have some sort of a recipe here. Yes, interest rates have kind of bottomed out, but there is balance is key in everything, and there is room for having a fixed income solution for your liquidity needs, for your, which could be liquid funds, arbitrage funds, etc., and for your uh, security needs, which is protecting your goals. I mean, I'm talking beyond insurance, and that could be again in certain mix of bonds or bond funds, and then strategic buffer, which could be again, and this is something that I think we use in our diamond strategy also for our portfolio investors, where all of this is managed in a seamless way for them. So, on that note, I think we'll wrap up this episode of M2M, and we've covered specific tips about how to use fixed income, even though the interest rates seem to be very low, how to leverage them, and build a balanced and powerful portfolio. So, anything else you want to add before you say goodbye to the audience?
So I will end with my usual phrase, happy investing.
All right. See you in the next episode.